Good morning. Welcome to Inside India. I'm Dan Murphy. Straight to your headlines at this hour. First, the Indian market's finishing on a one-year high ahead of the Diwali celebrations today. Still, it has been an underperformer, even among its peers. Are valuations starting to look attractive? We'll discuss. Plus, the Nikkei racing to a record high as fiscal dove Sane Takaichi is poised to become the country's first ever female prime minister. We're live on the ground. And gold stumbles as it tries to make another run for another record high, struggling to break past 4,400. Stanchart thinks it's not if, but when we'll get there. We'll get that view coming up on the program. Welcome to Inside India. Thanks again for your company this hour. Straight to the Asia markets and take a look at what is unfolding right now across the region. We're looking at a number of indices actually tracking at record highs here. It is firmly a green day this Tuesday. You can see the Nikkei 225 up by 1.5%. Also decent gains today out of Singapore, 1.23% stronger. Our top performer today is Hong Kong's Hang Seng up by 1.66%. The India markets are shut today and tomorrow, though, as the country celebrates the Festival of Lights, Diwali. There will actually be a special 1-hour Muharrat trading session that will take place at 1:45 local time. The special hour of trade is a tradition in the Indian market, marking the start of the Hindu financial year. Investors view it as auspicious, with hopes that trades done during that hour will bring luck and prosperity. So watch that space. Okay, to one of our top stories now, and it is Japan. The parliament there set to hold a session to choose the country's new prime minister later today. It comes after the ruling Liberal Democratic Party and the right-leaning Japan Innovation Party formed a coalition. But of course, it still faces numerical challenges in the lower house, coming up just 2 seats short of the 233 required majority. CNBC's Kari Joji joins us live now from Tokyo. She's been tracking all of these developments. Kari, of course, a hugely significant moment on the ground inside Japan for the nation's political history if Sane Takaichi does indeed become the country's first ever female prime minister. But as I've just said, the numerical challenges here loom large.
Absolutely. This is going to be a day of firsts for Japan. When Sanae Takaichi is voted in as the next prime minister, it would be the first time in Japan's constitutional history. You'd have to go back way to the 18th century before the Constitution when Japan had a female leader. But with the right-leaning Ishin Party, as you pointed out, rubber stamping the coalition late last night, it is certain that she is going to be the 104th Japanese prime minister. And it is there's speculation that she may have won over 2 or 3 parliamentarians to avoid a runoff in parliament, which begins in about an hour's time. So this was a last-minute deal that she cobbled together because the coalition, ex-coalition partner Komeito dropped a bombshell and said they're quitting. And she doesn't have a whole lot of time to rest. I mean, she's going to have to appoint her cabinet later on tonight, get rubber stamped by the emperor, and then she has to prepare for a full diplomatic schedule with U.S. President Donald Trump in town next week, and a lot on that agenda. Even with that trade deal inked between the two countries, there's a lot on the defense table, cybersecurity, trade, you name it. So I think this is going to be baptism by fire, if it hasn't already, for Sanae Takaichi.
Indeed, Kari. And of course, imagine climbing all the way to the top of Japan's political establishment only to face the final male boss, Donald Trump. What an incredible turn of events here for the incoming prime minister. Kari, before we let you go, though, are we getting any sense of who is actually going to be part of Sanae Takaichi's cabinet?
We are, and I think local broadcasters are starting to, report a lot of the people that could make up this cabinet. She has said that she wants to appoint more women to the cabinet, and I think one interesting post is going to be the finance minister portfolio. Satsuki Katayama, we've been talking about this all morning, likely to be the new finance minister, according to the public broadcaster NHK. She's an ex-revitalization minister, so she has plenty of experience, but I was interested to read an interview with her earlier on this year where she said that that dollar yen fair value she sees is around 120 to 130 yen. And I think Akazawa-san, the trade minister who shuttled so many times back and forth between Tokyo and Washington, is about to get a raise. And he's going to be appointed the Minister of Economy, Trade, and Industry. And I think some other names you might be interested in. I think there are going to be a lot of old hands as well. Shinjo Koizumi, who she ran up against, probably will get the defense minister portfolio. Motegi-san, who is also a veteran LDP politician, probably going to get a post too. So it'd be interesting to watch what other women she appoints to this cabinet as well, and she really sticks to that. This one name that you may not have heard of, probably no one's ever heard of, is Kimi Onoda outside of the Japanese sphere. She might get the portfolio of economic security minister. I think her mom's Japanese and her dad's American. But I think, it's going to be such a difficult few weeks. And I think big blanket spending might, the markets may be the ones determining whether she can actually implement some of those things. Dan.
Yeah, really good point. Carrie, thank you so much for joining us. And of course, let's see how the markets react to this as well. The 225 sub 50,000 at this point. We're seeing stocks trade up in the lead up to this announcement. Let's see if it's a case of buy the rumor, sell the fact. We'll watch this space. Thanks again. To the global trade front now, and US President Donald Trump and Australian Prime Minister Anthony Albanese signing agreements on critical minerals, which include plans for projects worth a total of up to $8.5 billion. It comes as China continues to tighten its grip on these key minerals. Take a listen.
In about a year from now, we'll have so much critical mineral and rare earths that you won't know what to do with them. They'll be worth about $2. But in the meantime, we're working with Australia and other countries. They're working with us too, but other countries also on that. But we're really working on anything having to do with military protection, military ships, vehicles, guns, ammunition, everything, the whole thing.
And on defence, we've already had a discussion about taking it to the next level. Our defence and security partnership with AUKUS is so important for us, and I thank you for the support that the administration are giving as well.
And a quick check on Chinese rare earth stocks this morning. You can see looking a little mixed here off the back. But despite the rare earth standoff between the US and China, US President Donald Trump also confirming his face-to-face meeting with his Chinese counterpart Xi Jinping at the APEC summit in South Korea as soon as next week, where he expects to make a, quote, very fair deal with Beijing. Listen in.
A lot of countries took advantage of the U.S. They're not taking advantage anymore. No, China's paying 55% and a potential 155% come November 1st unless we make a deal. And I'm meeting with President Xi. We have a very good relationship. We're going to be meeting in South Korea in a couple of weeks. And we'll see what we can do. We have a very good relationship with China, but, it's been probably a little bit like your relationship with China. They try and take advantage, but most countries do. I mean, I can say the European Union took advantage, but not anymore. We worked out a very fair trade deal. Japan, we worked out a very fair deal. South Korea, where I'll be meeting President Xi, we worked out a very fair deal. And I expect we'll probably work out a very fair deal with President Xi of China.
Speaking of the European Union, we also saw the EU strengthening ties with India after it unveiled a new strategy to expand cooperation across trade, technology and defence, among other areas. In a statement, the Council also clarified that the bloc and the Indian government aim to finalise its free trade agreement by the end of the year, which would include enhanced market access, removal of trade barriers and provisions on sustainable development. It also said it would continue to engage with India on all aspects of Russia's war against Ukraine, which is, of course, a key pain point in those trade talks between New Delhi and Washington, specifically when it comes to India's purchases of Russian oil. Meantime, India's economy remains resilient in the face of those global challenges. That is according to the Reserve Bank of India's monthly bulletin. In a statement, the central bank said domestic structural reforms are helping to offset slowing growth, adding that current conditions have opened up policy space to further support growth. The RBI also sold a total of nearly $8 billion in the FX market back in August to defend the Indian rupee, which of course fell to record lows during that period, actually breaching the 88 mark for the first time. You can see we're currently trading at 87.93. Well, let's compare the India markets with the North Asian peers, all in the green. But of course, India seems to be the laggard, up only 9% so far this year. South Korea, Japan and Taiwan all touching record highs, actually seeing double-digit gains so far this year. All markets saw a dip in April when those US reciprocal tariffs were first announced. But since then, gains in the Nikkei 225, Kospi and TAIEX have overtaken the Nifty 50. Well, let's bring in Matt Olson on this. He is Chief Market Strategist at Raymond James Investment Management, joining me live for a pulse check on how to trade it. And Matt, as you just heard, India really underperforming North Asian peers through the course of this year for a multitude of factors. But I want to ask you, you have called India your largest overweight outside of the United States. Is that still your highest conviction play in this market?
Hey, good morning, Dan. It's always great to join. And India remains a large overweight in my portfolio. Earlier this year, we've reduced the weight, leaned into some of the strength that you've had in China, especially given the position that the government has taken with respect to semiconductors. But I think a lot of that trade has already played out. And when you look at what has really driven the lag of India relative to other emerging markets, it's been a combination of valuation coupled with just not exciting earnings growth. And we're finally at the point where it looks like the Indian market is going to see an acceleration with respect to earnings growth. Earnings that have come in so far look pretty strong. And so I'm optimistic that you're going to see, I think, more flows start to come into India as investors take profits in other emerging markets. And it's one of the best economies with respect to growth in the world, strong demographics, partners with the West. So I think there's a lot of structural tailwinds that will benefit India going forward.
Well, Matt, your view is essentially what the RBI's latest policy review has also told us, saying a lot of the reforms underway inside India are helping to support domestic activity and, by extension, the market. At the same time, though, as you say, time and time again, we hear that investors in India are basically trying to balance these high valuations with patchy corporate earnings. And the question is, are we going to see earnings improve to the point that would actually justify a higher valuation for this market? So what gives you the conviction to say it's time to add to India rather than wait for more clarity on what happens on the corporate earnings side?
I think India's been an interesting market so far this year, Dan, because while the headline index has only posted 9% growth or so, when you actually look underneath the surface, it's been a really bifurcated market. You had incredible strength with respect to some consumer discretionary names, especially the autos, the auto manufacturers, especially ones that are leaning into this premiumization trend. You're seeing a strong IPO market. And so you've had this tale of two cities where technology's been a bigger laggard. Some of the more industrial companies or companies tied to industrial policy have been the laggard. And we just had Reliance earnings earlier this week, which look like they're starting to turn. It's a bigger weight in the overall index. And I think that durability is going to change. And I think when you look at the GST reforms that have taken place, you're already starting to see some of those changes that the government wanted to see with respect to better urban consumer sentiment, people spending money. When I look at data with respect to some of the quick commerce companies, it looks really good. So I think the policy changes the government has enacted are already starting to have an impact. And when you have a 70% consumer-driven economy, that's going to translate into improved bottom line as well. So it might take a little bit of time, but I think we're at the precipice of an increase in earnings to get back to where we were when you had the market strength in end of 2022 into 2023.
Matt, we've also seen policymakers stepping in to prop up an ailing rupee through the course of the year as well. What's your take on this most recent intervention, and how concerned are you by the path of least resistance for what is one of the region's worst performing currencies this year?
Yeah, I think that that's always been a challenge for foreign investors too, is the depreciation of the currency. And it's always hard to judge when you might want to hedge your currency trades. I think the big jumbo rate cuts that you had in June, that's over. I think the gradual path of cuts for the RBI is going to be gradual and tactical and not a structural, every meeting start to lower rates. So I think that will start to provide some stability to the rupee. I think a trade deal with the U.S. and stability with respect to the U.S. dollar will also provide additional stability. So again, I think it's more of a tailwind going forward than a headwind that it has been very persistently throughout this year. So that's another reason, I think, to start looking more aggressively at India with respect to emerging market allocations, just because of how significantly that market has lagged so far this year.
We're also in an environment where we're seeing lower oil prices and a weaker USD. Is that a headwind or a tailwind for Indian equities?
No, it's absolutely a tailwind for Indian equities. I think when you look at the Indian market, lower oil prices, which is a large input cost for the overall economy, that's really, really important. And I think it's encouraging that prices have come down so much. I think this might finally be the time to see India make a pivot, like I think Trump has declared. We haven't had any confirmation with respect to Modi making a change in oil purchases, but that definitely is a tailwind for the overall economy. And a weaker US dollar tends to be a tailwind for the emerging market complex broadly. And I think the weaker USD is a trend that's going to continue into next year. And I think that just provides a longer term tailwind for EM and India as well.
One of the other market narratives that has been playing out over the course of the last few months has been this feud over India's purchases of Russian oil. Not necessarily a new narrative, but still something that we're obviously paying very, very close attention to. You mentioned the prospects of a trade deal, and I think Russian oil purchases are also perhaps a pawn in that trade. What's the timeline on ending India's purchase of Russian oil? And at the same time, are we going to get some kind of mini deal before the end of the year?
I would love, Dan, to have a mini deal before the end of the year. I'm not so sure we will, just because there's so many other things that are happening geopolitically that have the administration and the U.S.'s attention. But I think marginal progress, the fact that talks have resumed and are constructive, I think that's a very, very good indication of the direction of travel. And I'm hoping that cheaper oil prices can lead to this sort of breakaway from Russia. India has been able to skirt all of these challenges for a very, very long time. It's been able to play both sides of the house. And obviously Trump has called them out on that. But I do think that they're going to look to make a transition, because I think the improvement with respect to sentiment, foreign investment in India from U.S. companies, U.S. manufacturing, which can help India really achieve its Made in India plans by bringing in technical know-how. I think all of that's going to be very important to Modi and the Indian government going forward. So whether or not it's December or sometime in Q1 of next year, I think that's my expectation for hopefully seeing tangible, constructive developments with respect to trade.
Yeah, and still a big question mark over whether or not India can actually wean itself off completely from those Russian oil purchases in any case. Matt, while we have you, wanted to take a deeper dive into the specific investment strategy you have in place right now as well. Just going through some of your key picks over the last couple of months. Of course, you have consistently backed these Indian private banks, ICICI, HDFC. What's making the banks stand out in this environment?
So, the private banks in India, I think, are the key play that have worked well. They've been a little bit weaker, but really strong earnings over the past week. What I like about Indian banks in particular is that they have significant, called mid-teens ROE. They have high-quality balance sheets. They are growing and have partnerships across the rest of the country. So ICICI, for example, has a growing private wealth management segment. So they're leaning into this idea of capturing more wallet share across the totality of their customer. HDFC's integrating insurance and asset management into their overall business as well. So they're looking a little bit more like the big vertically integrated players in the US. And so that's a really good long-term story for growth and compounding growth. So I really do like those banks. And I've also been very optimistic, Dan, on companies like Mahindra and Mahindra in the auto space, because they're leaning into this growing middle upper class in India that's able to spend up on automobiles and really carve out a niche in the country. And on top of that, they have exposure to farm equipment, which is also a key priority of the Modi government. And you've seen a great monsoon season, so they're seeing expanding margins in that space as well. So there's a lot of excitement in the country. You just have to be very selective with respect to what you're going to lean into as an investor.
Speaking of being selective, you also like some of these high-growth fintech plays as well. Paytm, Geo Financial also on that list. Do you think the valuations right now within those two stocks are justified in this environment, given their AI-driven models and the consumer reach that they have right now? Obviously, opportunity to scale here, but at the same time, are the headwinds within this sector, specifically when it comes to the CapEx spend?
Yeah, I think that's a question a lot of clients ask is how much is too much to pay for these companies. I think Paytm's a name that I've been in earlier, so I'm a little bit less concerned about valuations right now because, again, the company has been delivering growth, not only on the top line, but you're finally starting to see bottom line growth start to come as well. And just given their niche and command and market share in the space and the ability, I think, to now translate contracts to businesses as well as consumers, I think that strength is going to continue. Whereas in Geo Financial, what I really like about it is the integration of leveraging artificial intelligence to better acquire consumers and better target consumers with whom they want to extend loans to. So while it might be expensive, management has largely been executing on the growth plan it's laid out. And so I'm okay with that. I'm willing to pay up for growth as long as I have confidence that management's going to be able to execute and continue to capture the large total addressable market that exists.
Matt, just quickly, what sits on your highest conviction list, either from a stock or a sector perspective, as we track through the rest of Q4?
So right now I'm looking at consumer names exposed to GST. So looking at Eternal, Paytm, Swiggy is another name that's on my list that has underperformed but looks interesting if management's going to be able to execute and really ride, I'd say, some pessimism with respect to, I'd say, the ability of quick commerce to grow very, very rapidly given constraints in urban cities. So those are the top three areas I have in terms of potential adds if we see any weakness in the space.
Matt, love the conversation. Thanks so much for being here today. Appreciate your analysis. That's Matt Alton there from Raymond James Investment Management. We'll speak again soon. And as we tail off into a break, we'll leave you with some live pictures of the anti-corruption protests in Manila. Protesters marching near the presidential palace over allegations of massive corruption in flood control projects that have implicated several congressmen and public works officials in the Philippines. We'll continue to track these developments there. We'll offer a quick break. Stay with us. We're back in 2 minutes. Welcome back to the program. Well, in the global AI space, Amazon Web Services, AWS, suffered a major outage on Monday, impacting major sites including Amazon itself, Snapchat, Disney+, Reddit, and Canva. Many sites came back online within a few hours, but some services continue to have a backlog of messages that will finish processing in the next few hours. CNBC's Mackenzie Sigalos has the details.
A major Amazon Web Services outage disrupted apps, websites, and back-end systems across the internet all day Monday, with more than 11 million users reporting issues, stemming from internal network failures tied to Amazon's core database layer. That's a foundation that many cloud services rely on to operate, and when it breaks, everything above it fails to load. AWS says some services are now recovering, but user outage reports have continued throughout the day. Cyber experts stress this was not a hack, but it is a stark reminder of how fragile the internet becomes when just a handful of players control its infrastructure. AWS powers roughly a third of the global cloud market and generated more than $100 billion last year. Yet a single regional failure still had widespread ripple effects. One expert compared it to last year's CrowdStrike meltdown when a software update effectively shut down people's computers. It broke the devices themselves. This AWS issue is more about cloud infrastructure, where the systems that apps depend on stop responding. This outage coming just ahead of earnings, with AWS already under pressure. Its cloud growth has lagged Microsoft and Google, and its backlog now trails Oracle. Morgan Stanley called the incident not helpful to already fragile AWS sentiment. They expect Amazon to issue credits to customers. But despite the scope of the disruption, Amazon shareholders did not blink, the stock ending the day higher. For CNBC Business News, I'm Mackenzie Sigalos in San Francisco.
Up next on the show, India ringing in Diwali with gold back in focus. Prices keep rallying. What does the festive rush signal for precious metals from here? We'll speak with Suki Cooper of Stanchart on the other side of this. Welcome back. This is Inside India. We're deep into the third week of the US government shutdown, which is dragging on with no clear end in sight amid a partisan fight in the Senate over federal funding priorities. The top White House economic advisor, Kevin Hassett, was on CNBC overnight. He predicted the shutdown is, quote, likely to end sometime this week. Take a listen.
Now there's a shot that this week things will come together and very quickly the moderate Democrats will move forward and get us an open government, at which point we can negotiate whatever policies they want to negotiate with regular order. Now, I was very pleased to see that my friend Senator Shaheen from New Hampshire, a very sound-minded Democrat, came out and supported opening the government on Friday. So it means that there's sort of cracks in the Schumer armor. I think the Schumer shutdown is likely to end sometime this week. But I can tell you that if the story that we've been basically hearing from moderates that, look, we just can't do it in front of the No Kings rally, if that ends up not being true, then I think that the White House is going to have to look very closely, along with Russ Vought, at stronger measures that we could take to bring them to the table.
So there would be negotiations about what to do. We're running out of time before November 1st. There would be negotiations about what to do with the pandemic super subsidies for Obamacare.
Well, that again is an issue for the Senate. But the Democrats passed that law. It was in an emergency for COVID, and they ended it now because it was such an expensive law. And so it's the Democrats' policy. It's the Democrats' shutdown, and it's the Schumer shutdown. And really, the Senate needs to figure it out.
But it affects, real people and people in red states. And I mean, we're subsidizing health care for a lot of, but like it or not, that's just the position we're in. So there are certain people that either wouldn't have health care or where the premiums would go up so much. And not to say that it's, not Obamacare's fault, because there's a lot of flaws, but you see something where there would be some fixes put in to get Republicans to agree to do that?
Again, that's up to the Senate to negotiate. But if you look at the expiring subsidies, the vast majority of people, certainly low-income people, aren't affected at all. It's just that the policy was expanded to people up to 4 times the poverty level, and so you get people who have much higher incomes than were intended to be protected by Medicaid, and they gave them basically a free card as well back during COVID. And I think that some scrutiny about that is something that in the course of ordinary Senate business, I would expect senators should debate that. But this is about keeping the government open.
Kevin Hassett there. Meanwhile, CNBC's latest All-America Economic Survey took a look at how the government shutdown has affected healthcare. CNBC's Steve Leisman has a full breakdown of the latest survey.
62% of the public, according to the latest CNBC All-America Economic Survey, say they are satisfied with their ability to obtain quality health care, including majorities of those who have private and government health insurance, but Medicare recipients are far and away the most satisfied. 81% of seniors and 78% of Medicare recipients say they are very or somewhat satisfied with their access to quality health care. That compares with 60% of those on private insurance, 55% for working class Americans, and 46% for women 18 to 49. 1/3 of the sample of 1,000 Americans we surveyed nationwide report that they or a family member have put off health care because they could not afford it. That includes 59% of women 18 to 49, compared with 22% for women 50 and over. It's 34% for Democrats and even 25% for Republicans. There's a big gap with 42% for the working class saying they have skipped a medical treatment. That compares with just 15% for the wealthy. Democrats lead Republicans 45 to 27% on which party would do a better job reducing health care costs. 8% think both parties will be about the same, 19% saying neither. Meanwhile, Republicans hold a 39 to 24% advantage on which party is best to control overall government spending, with 7% saying both parties are the same and 29% say neither is any good. So it comes down to one party favored on health care, the other on spending, but what does the public want the government to do? 57% of the public say it's the responsibility of government to provide health insurance to all Americans. 41% say no. The majority includes 90% of Democrats, 58% of independents, and even 24% of Republicans. So the public looks to Democrats on health care and Republicans on spending. Both sides know their political strong suit, and that brings the U.S. to day number 20 of the shutdown. Steve Leisman, CNBC Business News.
Meantime, Robert Kaplan, the vice chairman of Goldman Sachs, spoke to CNBC about the impact of tariffs and AI and what all of that could mean for the Fed. Here's a slice of that conversation.
So tariffs, at least in the short run, have slowed growth. In the longer run, we'll see how that plays out. Also, the limits on not just immigration, but the fact that we've got 12 to 15 million undocumented temporary status workers where they're less sure of their status, that has also slowed growth. At the same time, you've got this AI boom. So it doesn't surprise me that away from AI related, we've got sluggishness, and yet we've got these tailwinds from AI coming. And so it's a mixed bag. And if that's what he's saying, it's a mixed bag. I agree with that. I think if I'm sitting at the Fed, though, when I look out at businesses, and in my seat at Goldman, when I look out at business isn't great, but it's not falling off a cliff. It's solid. It's sluggish to solid, depending on the area. And so I think I'm more optimistic that with tax incentives, the AI boom, regulatory relief coming, we could get some firming into next year. And that's why I think the Fed's got to be very careful. It may well cut in October, but I think the bar after October is higher than the market thinks about further cuts.
Let me get you a check on how U.S. Treasury yields have been shaping up through the course of the Asia trading day today. And of course, we have seen the 10-year ultimately trading in this range, sub 4% now. 3.98 is the level at the short end of the curve, 3.46% for the 2-year. The dollar index also in focus alongside the other Forex majors. And what's been interesting to watch over the last month is the downward drift in USD. You can see dollar index at 98.71, just catching a slight bid today, up by 0.13%, but still down quite significantly. And dollar yen in focus as we could potentially see Japan's first female prime minister coming through in the coming hours. Dollar yen at 151.11, just pulling lower at the moment. And of course, gold has been in focus as well. We're watching the festive season demand for precious metals in India as Diwali is underway. Gold at 4,348 US an ounce, up 65% YTD. Take a look at that chart. What a ski slope there. You can see pulling lower at the moment, down by just 0.15%, but not really the marked pullback that we saw in the Friday trading day that gold is seemingly happy to rally through. The precious metal hovering near record highs as it resumed its upward climb, but also hitting a wall as it tries to break past 4,400. Now, despite the elevated prices, buyers still turned out for the first day of the Diwali festival. It is traditionally seen as an auspicious day to buy gold, though many opted for coins, bars, or even silver instead to avoid those hefty charges. At the same time, India's gold reserves have just crossed $100 billion for the first time last week, helped by the global price rally and the inflows into gold and silver ETFs that are picking up as investors chase returns. So what does all of this signal about sentiment and the outlook for precious metals? We have an expert on hand to help us understand what could happen next. Suki Cooper is here, the Global Head of Commodities Research at Standard Chartered. Suki, welcome to the program. First of all, this record run that we've seen in gold, just walk me through your latest estimate on exactly what the price is going to look like at the end of Q4 and how much more steam does this gold rally actually have?
If we look at the foundations of this rally, yes, it started with a lot of central bank buying, record buying over the past couple of years. But this year, that buying momentum tilted towards the ETF buyers. And that has accelerated at a pace that we haven't seen since 2020. In fact, we're now just 20 tons shy of the all-time high that was reached in October 2020 in tonnage terms, yet we've already hit record highs in dollar terms. But what's been interesting since the rally at the start of September is that the momentum has been incredibly fast. So we've seen the universe of investors expanding quite rapidly into the gold space. But because that momentum has been very, very quick, we've also seen that the India buying has accelerated at a pace that we do expect to see during a seasonally strong period for consumption. But normally higher prices tend to dampen that sentiment, and that hasn't happened. So on the one hand, we still have strong investment demand. On the other hand, we still have a good, solid physical floor in terms of India's appetite. But our concerns arise, what happens when India's demand slows down? We're moving past the Diwali-related buying at the end of this week. We will then have wedding-related buying that will help to keep some of that momentum, keep that momentum risen. But we think that prices are ripe for a correction in the near term. We are expecting record highs going into 2026, but prices have been trading at overbought territory since the start of September. So for a healthier upward momentum, a short-term correction would actually benefit the longer-term trend.
Suki, how deep do you think that correction is going to be?
We're forecasting prices to average $4,000 per ounce in the fourth quarter. So we do think that we could see a dip below that 4,000 mark. In the near term, we have technical levels that we're watching, and prices are quite, we're still seeing that quite a strong momentum on the upside, but in the near term, we will be looking at levels around 4,200 and then the 4,000 mark. So we do think that if we see a dip in prices, it could be a sharper correction.
I've spoken with other analysts this week who are much more bullish. They say gold is on track to test $5,000 an ounce at some point next year. Do you think that's a realistic price target?
We're forecasting prices to average 4,488 over the year as a whole, but in the fourth quarter of next year, we forecast prices to average 4,750. So given the volatility that we see in the market, given the trading range, we do think that $5,000 per ounce could be a target that prices hit as well. But I think on the broader momentum, we need to see if the ETP buying continues at the pace that we've seen over the recent weeks. And it has really accelerated at a pace that we haven't seen since 2020 over the past few weeks, and that momentum would need to be sustained.
Suki, let's talk about some of the other narratives around gold right now. And you mentioned the Diwali effect. That is, of course, also feeding into the price momentum. But at the same time, the US government shutdown continues. Historically, this political gridlock has impacted gold prices. But do you think the full extent of the US shutdown is being adequately priced in?
When we look at how gold has responded to previous shutdowns, we don't always see a consistent response. It depends on the market sentiment, and it depends on which point of the hiking cycle or cutting cycle we had entered into. If we look at the 2018-2019 shutdown, which is the longest period we have to analyse, gold prices over that period only rose by a couple of percent. So we didn't see a significant firming in the price action. But also the sentiment at that point wasn't as bullish in the gold space as it is now. We've had a number of structural factors that have really supported this rally, and a number of those remain intact, whether it's concerns around fiat currency debasement or whether it's concerns around Fed independence. The shutdown itself has not been a trigger that has seen gold prices rally, but it has added to that underlying concern, risk, and uncertainty in the markets. So coupled with the ongoing concerns around geopolitical risk, we've seen that investors have continued to want to add to their safe haven allocation and looking to increase potentially that target allocation as well.
Two other factors also at play here. Of course, this week we have US and Chinese officials set to meet in Malaysia to discuss the trade and tariff outlook as well. Some have suggested that if we did see a positive development on the trade front, then we might see some of the premium coming out of gold. And then the other factor that we haven't mentioned yet either is what's happening with the US Federal Reserve. It seems to be there's rate cuts that are being priced in, but of course the full extent of the Fed easing remains to be seen at this point, and exactly how that translates into the commodity space is also a big question mark here too. So what's your take on those two factors as near-term drivers for gold?
The geopolitical elements and the uncertainty around trade risk has certainly been a structural factor that has supported this rally. If we go back to 2022, Russia's invasion of Ukraine, freezing of assets, was that initial trigger that saw a significant allocation into the gold space. And then if we look at Fed rate cuts as a driver for the gold market, that relationship had actually broken down over the past couple of years. But it was in July this year that the relationship picked up again and that correlation became stronger. We're forecasting 2 more Fed rate cuts this year. We think we'll see 2 more 25 basis point cuts. and then we expect the Fed to be on hold in 2026. The correlation at the moment remains strong, so we think that the market is certainly focused on the scope for a rate cut next week, and we think that will continue to keep some of that upward momentum in prices. But if we start to see indications that the Fed will be on hold, then we think that will actually contribute to gold prices correcting in the short term. We do think the longer term remains intact and we'll see higher highs. But if the market recalibrates its expectations in line with what we're thinking, then we could see something of a short-term correction. But the trade uncertainty has been another string in gold's bow that has helped to see prices rallying. And in this regard, some of the uncertainty has been around allocation of stock, but some of it's been around broader concerns around deglobalization and the need for a safe haven asset or the desire for a hard asset. And that element of it, we think that there could be some scope where we see some profit taking, some corrections, but there are just many drivers behind this rally. So it's not just a single factor, if it turns positive, that we think that gold prices will lose that upward momentum. We would need to see a series of factors starting to become less favorable for gold.
Okay, fair point. Suki, we can't have a conversation without gold. About gold without mentioning what's happening in silver as well, which also hit a record high last week. But of course, the silver rally is really lagging what we've seen in gold, hasn't quite matched this outperformance. Walk me through the fundamentals behind this leg higher in silver, and also specifically, can you unpack this liquidity crunch that we saw in London silver market as well? Quite an interesting day, indeed a week of trade out of London that resulted in some traders scratching their heads.
The silver market is a fascinating one. It's been undersupplied for the past 3-4 years, but it hasn't necessarily elicited the same sort of response that we've seen in the gold price. And one of those reasons is the fact that gold initially started this rally on the back of official sector buying, and that momentum doesn't exist to the same extent, or it doesn't exist in the silver market. Silver is a much more industrial metal. So on the supply side, supply is much more diversified. Only a third of silver production comes from primary producers. The rest of it is a byproduct. So you're less likely to see a price response immediately impacting the supply side. And recycling has been grown. It has responded to higher prices, but not to the sort of pace where it's really dampened the huge deficit that we've seen in the market. On the demand side, silver has benefited from ongoing growth in terms of solar demand, the electrification of vehicles, and the rollout of 5G networks. So there's a lot of underlying factors that have supported the silver story. But this year, when we've seen those macro factors becoming much more significant driver for the gold space, we've also seen it spill into the silver market. And we've seen the ETF buying hitting tremendous levels across the silver space, exceeding 3,000 tons for the year to date. And that's just exacerbated that market deficit that we see for silver, and it's helped propel prices higher. But there is silver inventory. Typically what we tend to see when we have these price tightness in the market is that the wrong type of silver is in the wrong location, and that's happened again this year. We've seen around concerns around tariffs, a lot of metal was shipped to New York, and inventory actually hit a record high on the 3rd of October, exceeding 530 million ounces. That left less metal available in London. Ordinarily, some of that metal would be allocated across to the ETFs, but what was different this time was the demand from India. We've seen the seasonal buying in India not only benefiting gold demand, but also driving up that silver consumption. In fact, silver imports in September more than doubled month on month and year on year. So it was a huge response that we saw from India, and that resulted in a very tight market in the London market. So it was not only the metal had been shipped to New York, but also we had this pull towards India that left less available, and a lot of market tightness pursued in the ongoing sessions last week.
Okay, Suki, really well explained. Always appreciate your time. Thanks so much for checking in today. Looking forward to speaking again soon. Suki Cooper there from Stanchart. And staying in the commodity space, we have been talking about rare earths and critical minerals ahead of the Trump-Xi meeting next week. USA rare earth seeing double-digit gains and now hitting an over 175% rise year to date. Our US colleague spoke to the company's CEO about the need for the US to develop its own sources of these key minerals in light of China's global supply squeeze. Listen in.
We think it's important for the government to recognize, as Secretary Bessent said last week, China has been behaving in non-market-driven ways. And so things that the government can do to help create market incentives so that the private sector can step up and do its good work, that's really important. So we're seeing things that like offtake agreements, we're seeing things like support and permitting so that we can move faster. These are the kinds of things the private sector is asking for.
Right, but not a capital infusion or taking an equity stake, things like that?
There may be choices for that. We at USA Rare Earth, we are well capitalized and debt free at this point. And so we're going to play our role in bringing this whole sector forward.
So, but what would it take to really ramp production, which seems like we need now?
Yeah, so imagine a network outside of China where there truly are mines producing the heavy and light rare earths. All of those are on accelerated development right now. Second, there's processing, as you point out. And there are experts. Did you know that France, by the way, is an area with true expertise in processing? What we're going to be doing is building a short-term, a medium-term, and long-term strategy so that we bring all of these assets to scale. And it's a brilliant moment to be just relinking the supply chain.
But to get to your ideal level of production would be I'm guessing a decade-long process, multi-decade?
We have plans that stretch out across the decade right now. Magnet making will begin. In fact, my CFO loves to talk about this as the magnet to mine strategy as opposed to the mine to magnet strategy. We're going to be building magnets. We're going to be using supplies, feedstock from, at home and around the world. And then ultimately, we need that whole supply chain to be growing and strengthening as we expand.
So what percent of ideal production do you think the U.S. is at right now in aggregate?
Oh, I don't think I have those numbers,
really?
Carl, but it is small. It is small.
So in innings, we would be talking about the first inning.
We are in the early innings, and it's a great opportunity. Let me tell you about two things that I believe are going to happen next. One, I believe that our auto manufacturers and others in the industry are going to start to agree on how to build the demand signal for these outside of China rare earth elements.
In terms of commitments.
In terms of commitments.
Right.
So we have offtake commitments. Second, I think there's innovation happening at every step along the chain. So this is a great moment. The future demand for permanent magnets is going to do nothing but grow with the advent of physical AI. The introduction of robots, anything that will need to be actuated and moved is going to require this technology. So this is a technical sector that we can see growing significantly in the coming years.
It's great, but do you fear that there's going to be a gap in terms of when it's ready and say what our U.S. military needs? That's one of the concerns.
Well, this is why we need to make our U.S. defense a priority. Now, this is not the biggest demand signal that we have, but it is the most important.
Right.
So we've, obviously, we've been very transparent about the fact that we're focused on the needs of the Department of War and making sure that in the assets that we control, we will prioritize support to the defense sector.
Good morning again. You're live on CNBC. Let's get you one final check on the Asia markets before we wrap up this edition of Inside India. It's a great day across the region. Actually, some equity markets here have been trading at record highs. Take a look at some of these gains. The Nikkei 225 has been paring back, but still up by around 0.9%. We're also seeing Singapore's Straits Times Index up by around 1.33%. And the outperformer today has been Hong Kong's Hang Seng up by 1.65% as well. Hey, stay with us here on the network. We are back in just a few minutes' time. Join me for Access Middle East. Thanks for watching Inside India. We'll see you in just a couple of minutes' time.